Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Technical Analyst with Sticky Trades. Hope you're having a good week. I'm starting off this report with SLV. Hopefully you had a chance to catch me on X, where I posted a trade today that I just want to review. If you remember, back on January 30th, I put this out on X showing our followers that I would be selling 5% of my position based on the signals that I posted for the general public. And so that was the lead-in. Remember, I put this out before I make my trades, giving the general public who wants to trade to do that ahead of me. I don't trade ahead of the audience to take advantage of that price movement. So that is what went out on Thursday. And then today, earlier in the morning, I put out a post. You can see it went out at 9:38 a.m. this morning, showing everyone that the gap fill target had been hit. Again, I highlight that on the charts so those who are following could learn how to trade gaps. And so that was the buyback. And if you're interested in ghosting or following my trades, all you have to do is go to X and type in hashtag AJSLV trades, all one word right there, and you'll be able to follow along with my SLV trades. I have not missed on one of these yet. For those of you who've been following along, I know I get comments from people who are trading with me. I don't suggest that you trade outside of your boundaries, nor do I give you recommendations. This is just looking at what I'm doing as I show the public my actual trade. This is my most public position that I trade. Our members obviously have access to my other positions that I trade, but I just want to give this one out to the general public as a freebie. Number two, if you look at what's happening with SLV, now that that gap is filled, we're going to have to wait to see if the CCI starts to turn up. If that is the case, then we could very well see silver move back up to the highs right here, right around 2130 or so. So stay tuned, keep your eyes on X, and I'll report back when the time comes. Now let's get to the general markets. If you had a chance to watch my midweek report, I did comment on all of the major market indices, suggesting that we would pull back by Friday to fill this gap. This was the only new target that I threw out for the week. And that target is down here at 380.46. Obviously, that did not hit by Friday, but I do think we're going to hit that next week. Stay tuned. Keep an eye on the technicals and also keep an eye on the data. I'm going to report on that at the end of this report so you can understand again how manipulated this market is. It's a very dangerous time for traders and investors, so be very, very careful. Again, to reiterate, that downside target is 380.46. Now, again, if you followed the Wednesday report, I said that we'd have a good chance of hitting the downside gap on IWM. We did, in fact, hit that. That downside target was 191.58, and yesterday's low was 191.53. So we surpassed that by 5 cents. That's not unusual for me to hit targets like that. In fact, if you check our YouTube page, we did something that is very rare, and we posted the rapid fire stock analysis session from Wednesday, where I went over 65 stocks in 60 minutes. Now, you have to keep in mind when I get comments from people who I could obviously tell are not traders because they're always in this category of, oh, you're right, you're wrong. Trading and investing is not about being right or being wrong. It's all mathematical. It's probability and outcomes. And if you've taken a statistics class, there's nothing about being right or wrong in statistics. It's, again, the probability of these occurring. We have a third-party software program that we use through a validation company that shows the percentage of accuracy on all my picks going back a number of years. Thousands of stocks have been analyzed on these Wednesday calls and on these weekly market reports, and the software tracks that at 83% hit rate to the penny. Yes, 83% is not 100%, but it's certainly the best percentage of hit rate that you're going to find anywhere in the world. So trade accordingly, knowing that 17% of the time you're not going to hit your targets. Does that mean you're going to be wrong if you don't hit your target? No, you'd be absolutely wrong if you didn't manage risk. after not hitting that target 17% of the time. But it's all about risk management. It's all about technical analysis. So for next week on IWM, you can see that we're right exactly at the zero line. There's just neutral right there. So what I'm going to do is I'm just going a tad lower to this low of 191.11. And again, looking at IWM, you could see the percentage of time that these targets have hit. Each one of these diagonal lines are former targets, and you could see how often they are hitting. This one did not hit. This one has not yet hit. And so when you total all that up over a number of years, you see the percentage of accuracy right there in front of your eyes. Is that my ability to read into the future? No, it's just my ability and your ability to be able to read the technical signals, because that's all we have to go on right now, because obviously the data we're getting is corrupt. And again, I'll show that to you. You have to be very, very careful. So that downside target's still in place for IWM. Let's go to the Qs. If you're watching what's happened with Facebook and Amazon, you could see that our markets are being driven by a handful of stocks, 7 in particular. And you could see that there's a craze going on in the tech sector especially. So I am keeping this downside target longer term in place of 409.53. But look what happened today on that green candle. We filled the gap from Wednesday. We gapped down here. So we did fill that gap, leaving a gap below the market. So I'm keeping that downside target in place of 409.53. We have a negative divergence here on the CCI. Yes, we do have an increase in volume. It would be nicer for the bears if we had a decrease in volume, but I'm still keeping that downside target right there of 409.53. Now, if you go to SPY, it's the S&P 500 ETF, and I'm going to talk more about this. We do have a breakout now of a high on slightly higher volume. So this one, I believe, is going a little bit higher on Monday and or Tuesday. Then we'll have to look for a volume drop. So once we get that volume drop, and I'll just put a little reminder there with that horizontal line, once it goes higher, hits that target at 496.99, I will be looking for that drop in volume, at which time we will most likely see a hinge down here on the CCI, because it's very sensitive to volume changes. So SPY a little bit higher, then we'll look for the drop in volume for the second part of that forecast. Now looking at the VIX, you can see here that we are still above that 20-period moving average. Can you see what's happening down here? John Murphy years ago on CNBC would call that a rounding bottom. We saw that back here as well. Rounding bottoms are extremely bullish longer term. So we have this rounding bottom on the VIX, and if you recall, you'll know that for the most part, the VIX is inversely related to the S&P. So if we're having a rounding bottom with eventually higher prices on the VIX, that means that we're most likely going to see lower prices in the SPY and the SPX. So be very careful with trailing your stops if you're long, making sure you're taking your profits or protecting any of your investments so that when this thing breaks, you're not going to get hurt. You'll be able to protect yourself. Now, going to the geopolitical news, please understand that my percentage of accuracy of 83%, which again is verifiable, is based on a 7-point trading checklist that I put together. If you would like a copy of this, visit us at stickytrades.com. We're putting a video together. We're putting out added value through a service, through our third-party validator, that's going to allow you on our website to put in a ticker symbol to see how many times I've analyzed that stock and the number of times that the targets have been hit. Again, something no one in the world is doing, but we're working on that as fast as we can to get that out to our members especially. So take a look at what's going on here. You hear about the non-farm payrolls going up. Well, understand this is a big picture that's being painted. The economy is not as good as the data would suggest. This was big news coming out of UPS, cutting more jobs. And if you look at the number of companies that are laying off people, the list is getting stronger and stronger. And so this is the first in the shipping industry to start these layoffs. So again, I'll explain what's happening with non-farm payrolls in a minute, but you have to take everything in stride. You can't just look at one report and have a knee-jerk reaction. Oh, let's go. The economy is fixed. We're back to a bull market. You're going to get yourself in trouble if you do that. Now, if you look at what's happening here with shipping costs, they are going up ever since the turmoil began in the Red Sea. This is going to affect inflation. It's going to affect the cost of goods. It's going to affect your sending a package through UPS or any other shipping company. And that is ultimately going to eat into the pocketbooks of every consumer. This was the manufacturing index that came out this week. And again, something you have to pay very close attention to. I got this from Liz Ann Saunders over at Schwab. And you can see here, if you go back and look at history, look what happened just prior to the crash of 2008. We had a severe drop in this index and it went negative. The same thing happened right before the COVID crash. This manufacturing index was dropping and then eventually crashed. Well, here we are once again in negative territory, and it seems like not many people are even talking about that as the frenzy continues in tech. All right, so looking at the Magnificent Seven, we have 6 of them right here. Looking at the earnings, this is pretty fascinating because you have to understand that there's 6 stocks that are now driving basically the entire market at this point, where these 6 stocks had a combined earnings from the fourth quarter 53.7%, while the remaining 494 companies in the S&P are expected to see a 10.5% decline. What does that look like on a chart? Well, there you go. This says it all. These are the Magnificent Seven climbing away, but look at the green line down here. This is the S&P minus the Magnificent Seven, and that is most definitely in a decline. Now, the institutions are reacting to this, by the way, while the sheep in the market continue to buy in based on what they see on the financial programs. You can see that retail is buying. Who's retail? That's me, you, and many others who are basically following the leader and talking heads. But check out what happened last week with the institutional money. Institutional money is coming out of the market in a big way. And so again, while the retail and some of the hedge funds are putting money, now hedge funds are different than institutional money managers. There's a big difference here. Hedge funds, many of them use options and hedging techniques, so that's not as significant as what we're seeing on the institutional side. But you have to watch what they're doing, not listen to what they're saying. This is the evidence that I talk about. The proof is in the data when you dig into it and combine that with the technical analysis. Here's another one, looking at yields. After yields top out, now this is, again, based on history, stocks typically rally to new all-time highs. This is exactly what we're seeing, especially this week. But history also shows a sharp drop in yields, and that leads to major market crashes and recessions. Again, this is history proven to you. Looking at these arrows right here, you see how the yields will drop, and what happens shortly thereafter. These gray areas are the recessions. This was the Great Recession back in the financial crisis, and I expect we're going to see some gray areas showing up here on the right side of these types of charts very, very soon. The market is basically factored in that the Fed is going to lower rates, but when you see inflation, real inflation coming in, then you're going to have to think again, because if the market is betting on Fed rate cuts and that doesn't happen, that's going to shock the market lower. And this is another graph that shows exactly what I'm talking about. Please do yourself a big favor and read up on the LEI. This is the leading economic index. This is an index that basically tracks the 10 most important leading indicators in the economy. And let me explain what's happening here. Back before the crash of 2000, you could see right here, the market led the economic indicators. Right? See, the red line is lagging the market at that particular point in time. And just prior to the downturn in the crash of 2008, we had a hinge forming here on the leading economic indicators, and then the indicators led the market lower. Now, it doesn't look like much here, but if you go back into history and look at what the results were here, the general markets dropped 50% over a 3-year period. 50%. Understand that what I'm talking about with the March 2020 lows puts us at roughly a 50% drop once again. So I've not lost sight of my long-term targets. So you traders out there that are looking to trade day for day and you ignoring this, you're going to get yourself in trouble. So when I, again, see comments from people, I have to chuckle, but it's not funny because there's a lot of people who have never lived through these times here of the crash of 2000, and it duplicated again in 2008, where the leading indicators here, in a very rare occurrence, led the market back up into this huge bubble right here. And then once the indicators started turning lower, we had the crash of 2008, which again caused the markets to drop 50% in 1 year, not 3 years. It dropped 50% in 1 year. It was devastating. And then we hit the bottom and went into the greatest bull market of all time. Now, look what's happening right now. This is a first-time occurrence. The market is trying to lead the economy higher, but the indicators are saying the opposite. The indicators are dropping like a rock. And again, for the first time, we have this massive inversion or diversion from the leading economic indicators in the general market. This means big trouble right here, folks. So be careful. All right, now, this came out this week. This is the ISM manufacturing prices. And we talked about this last night on a webinar that we had with our members. Let me explain. This number, 52.9, was a blowout. An absolute blowout, telling us that if these numbers are true, inflation is still running very hot. So the chances of the Fed cutting rates with numbers like this are extremely slim. Doesn't matter what you're being told as far as a soft landing and all that colorful language that's being used. This was a blowout of a number. Now, if you go to forexfactory.com, I'll leave the link in the description box below, you could see why traders care about this. This is a leading indicator of consumer inflation. When businesses pay more for goods and services, you have to understand that the higher the cost for them, the higher the cost for us, because that gets passed on to the consumers. And remember, we talked about this last week. Consumers are still being stretched with credit card debt, lack of buying power, and they are in trouble, and bankruptcies are on the rise. So this is a blowout number. It's going to be very interesting to see if they revise this number moving forward. I wouldn't be surprised to see any of the numbers being revised, especially non-farm payrolls. So keep an eye on the revisions. They generally do that in the middle of the night when all of us are sleeping. All right, remember I say keep your eyes on China. Look what's happening in China. There is a fallout right now, and there is no bottom in sight. The Evergrande Country Garden debacle is getting much, much worse. And what happens in China generally trickles on over into the U.S. economy. So keep your eyes on the charts. Keep your eyes on sticky trades. We're going to do the best that we can to help you. Stay tuned, and I'll talk to you on the next video. So long.